So welcome to this week's episode of Leaders on a Mission, where I am joined by inspiring leaders driven by the impact of creating a healthy and sustainable world. Now, in today's episode, I'm joined by Eli Ziskind, a partner of Aqua Capital. It's a private equity firm that manage investments in innovating sustainable businesses across the agribusiness and food value chain. Eli, thank you very much for joining us today. I know you're a busy man.
Thank you. Thank you for hosting me. Pleasure to see you again.
Excellent. So let's take it all the way back. I'm interested. You've had a career in investment. You've had a career in agriculture. Where did it all start from you? Where were the forces, the key forces that helped shape, really helped shape your career?
So look, I was brought up in Israel, as you can probably hear from my accent. I'm always telling people I left Israel 13, 14 years ago. Accent is a bit tougher to get rid of. But I grew up in the north part of Israel, in a city called Haifa. It's a blue collar working class city, and my father was at that time, he is a veteran of the dairy industry with a 30-year career. So I really grew up into agriculture, as a matter of practicality. We kind of lived and breathed dairy. He started, his career was kind of interesting for me to follow. He started as a production line worker and kind of moved up the ladder all the way to a CEO, a divisional CEO role within his organization. And so I grew up into food, and I think it was a combination of what my parents did. My mother was an embryologist and focused on IVF. My father was focused on the dairy industry. So I kind of grew up into food and science, and as an Israeli person, entrepreneurship was kind of all around us. And so these were my, at least kind of upbringing forces that shaped my personality, I guess. And Israel is obviously a great place for ag tech. If you think about genetics, smart irrigation, fertilizer, nutrition, breeding, many of the big inventions in the ag today and in the food side today actually came up and started in Israel way before ag tech and food tech became as fashionable as they are today. So that's kind of how, or at least I see that.
Yeah. Okay. And great stuff. So when did you leave Israel? So I suppose you left Israel, and then it looked like you followed the career of banking, as it were. Was that always by design?
So I left Israel. I left Israel in 08 or 07 to move to banking. Got into Credit Suisse, into investment banking, into their analyst program. At that time, I didn't know exactly what is investment banking. It was kind of a language I wanted to be able to speak, and I thought about it as a 2-3 year adventure, and then I'll move on. I ended up staying there for almost 12 years. I started in Europe, actually in the emerging markets side, and quickly moved into industrials, where together with a colleague who then I joined him in the US, we created the agricultural practice, where at that time, Credit Suisse was focused on agriculture, but more sporadically, and we kind of really built a business around it. That while at Credit Suisse, we've done a lot of deals in the ag space. We've advised Bayer on Santo acquisition. We advised ChemChina on the Syngenta acquisition, a special component to it. We've done many IPOs, from Evogen in Israel into Arcadia Biosciences, Mosaic, Fosagro, and more recently Benson Hill. And so we've done a lot of things in ag and in food. And so at Credit Suisse, after some time in London, I've moved to New York to get close to some of our North American clients, and again, it was a great period where I got a lot of good exposure from various levels of the value chain, from fertilizers into seed, into chemicals, into technology, genetics technology, synbio, etc. So great learning experience for me.
Yeah, no, great. And tell me though, at the beginning, when you were there at the beginning, you mentioned with your partner, you kind of developed the practice. Did you see, was there just an opportunity? Was it one of those underserved sectors where you could see breadth and opportunity maybe and growth within it?
Yeah, look, like many things in life, it was a combination of being at the right time at the right place. As an Israeli, I got close to a few companies in Israel. I think it was Evogen at that time, Adama, which today is part of ChemChina, and Israel Chemicals. We did some work with these guys. We won a few mandates, and then I was, part of being Israeli is try to find an angle. And while in banking, I always try to find my own niche, whether this is covering a specific market, covering a specific sector. What I wanted to do is to decommoditize myself by being an expert in a space. And I took a bet on agriculture because, I said, this is a sector that has all the fundamentals to it's kind of a dormant sector, if you will. There's back at the time, we had the big six rather than the big four of the industry, but we had a lot of smaller technology companies, technology-oriented companies that the big folks were acquirers. And so I said, look, this is a huge sector. Agriculture is one of top 4 or 5 GDP contributors. It's a sector that is not really organized, hasn't been active, dormant, hasn't gone through a digitalization. Has gone through a few revolutions in the past, an industrial revolution, a bio-revolution, but still have a lot to explore. And I said it's not really well explored by investors who are focused, and also by the service providers as bankers, lawyers, etc. And so I, again, naturally as an Israeli, I got attracted to that. The bank was very supportive of giving me the platform to operate that business in. And so we're really initially opportunistic. And then I think, we're very lucky to play a part on some of these major consolidations, which convinced the bank, hey, there is money to be made here. This is an industry that is emerging. It took it a bit of a while. I remember when we did the IPO of Evogen and Arcadia, in our minds, we were thinking that we're creating kind of a new asset class in the sector, that this will become what we think of biotech today, early stage companies that could be huge in a couple of years' time. But evidently ag is slower than many other sectors. That's in a way, that's the beauty of that sector. Things take a while, but when they hit, it's a very sticky and very stable business. And so from that point of view, what we thought would really come in 2013 is beginning to shape in now with companies that are coming with interesting offering. And so, so it's a long-winded way of saying we're a bit opportunistic on it, but we did have the initiative at the time where other banks and other organizations just didn't have.
Yeah, absolutely. Maybe there was an easier buck out there for people to chase, basically.
Yeah, true.
No, that's great. And tell me your journey into Aqua. Tell me a little bit about Aqua, for instance, and your mandate there.
Yeah, I mean, part of as I kind of developed my path at Credit Suisse, I wanted to move from being an advisor into being a principal. I thought that this is an interesting time to be a principal investor in that space as it gets more professionalized, as it gets more international, and as interesting trends are coming into that sector. I was kind of thinking, I was still at the bank at the time, and I was thinking, whether I should go into the VC route, more growth oriented, or private equity. But as from a philosophical point of view, I'm more value oriented investor, and so PE P and growth are always more attractive for me than early stage investing, which requires, in my view, at least more of a technical understanding of the product, of the problem that you're solving, which wasn't necessarily my forte or where I wanted to focus my time. So I have, conceptually, I've started looking into that space. I've made a few personal investments in, again, as a principal investor on that front. And Aqua and I have been working together for quite some time. I was selling a portfolio company of the fund called Fertilaca, which was a super interesting biostimulant and specialty nutrition company. We at Credit Suisse had the mandate for some time and have been working with the company. We were kind of looking at windows of the market, and so I was really in touch with Aqua for 4 or 5 years before joining, around that mandate and around a few other things. And as I tell some of our target companies or some of the investors we're speaking to, we're kind of in a reciprocal diligence process for about 4 or 5 years. The firm on me and myself on the firm, and that was also a time where Aqua evolved. I think, and kind of continued shaping their investment philosophy and evolved into a large organization. Many of their portfolio companies became market leaders. And so, we had a period whereby we spoke, we kind of aligned on the way we see the world of ag being shaped up, et cetera. And so, at the end, I think kind of we started talking a while back, but the discussions became more focused and, at some point 2021. And so in the summer of 2021, having gone through very, very busy period at Credit Suisse, I think we've done about 10 or 12 deals in about half a year. I decided to move to Aqua. Aqua was kind of focused on broadening their reach into two things. One, broadening from Latin America into North America, but also broadening their philosophy from investing in buy and build situation or control situation into investing in growth, really, as in some cases minority investor, which is something the fund hasn't done before. And so we align, we're fully aligned on thesis. And then I've joined the firm summer of 2021 as a partner, again to help the fund grow, expand, and have a flag and a home base here in North America.
Great, very exciting. Amazing how paths cross, as they would do, right? And you end up really getting to know someone in a company. It makes life a lot easier when you go join them, right?
Yep.
Around that. Tell me a little bit about the thesis then, in terms of the segments that you're particularly interested in playing in.
Look, I think when I think about Aqua, and that's what really inspired me at the fund, Aqua is an operational focused private equity. If you think about the North American model, leverage, size, and in some cases, the firm is taking more of a high level approach. In a way, this is the opposite of what Aqua is doing. And the reason for that is that the core of Aqua is really accelerating family-owned, mid-sized family-owned companies. And so in many cases, Aqua came in order to help these companies break a glass ceiling and really go to the next level. And that was done through really getting into the business in, for example, changing their sales force and sales strategy, changing partnership, making production facilities more efficient, as well as acquisitions. And so Aqua has an approach which they've developed, which is an operational approach. And as a matter of fact, many of the firm professionals are in fact operators, previous CEOs, previous COOs, previous head of strategies of large companies. And we also employ a route of having our analysts, associates, and VPs taking operational role in the company, having a secondment program whereby an investment professional would go into a company as a carrying a specific function in the company, whether this is business development, whether this is finance, etc., and then coming back to the fund, which is something pretty unique for us. And so that's how Aqua started, and obviously in Latin America the fund has done extremely well. But I found these core strategies pretty rare in North America too. And so when we speak to North American companies, either as a growth investor or as a control investor, we have a lot to offer them from that operational perspective. As an example, we can take North American companies into Latin America, which is a very relevant market both in the ag and the food side, effectively doubling their TAM and help them and give them very seamless penetration into one of the largest ag markets in the world, which is very appealing. We can help, again, companies that have managed to reach some scale but need to break through with a sales force optimization, with an acquisition to help them really scale up. And so our core values as company builders are really appealing here in North America too. So taking a step back, the fund is focused on food and ag throughout the whole value chain. And our investment approach is really thesis driven. We sit down as a group. We actually really do it as from our founder Sebastian all the way to our interns. We sit down around the table and we throw theses that could be relevant. As an example, biologicals on the crop protection side, biologicals in other areas. We've made a few investments on the biological side, both on the crop protection side and the animal feed. Distribution or specialty distribution, taking it to various directions, direct to consumer food, specialty ingredients. We decide on these theses, we explore them, and we usually partner up with an industry vet or an industry expert to help us execute a strategy within a sector. And so within food and ag, we're typically very focused on the strategies that we'll do. That doesn't mean to say that, when there are interesting opportunities, we'll not take a look at them. But usually we have a good idea of what we want to do. We're very much aligned on it. We have our targets, we have a thesis, and we usually execute upon that. And that's, again, within the food and ag. I think our firm has a bit broadened the scope in terms of food and ag. We're looking into, as time goes and as impact is becoming more relevant and more prominent in our space, we're looking at other technology-oriented segments within food and ag where you can make more with less, and where you can enhance an industry with a technology-oriented approach. But that's kind of how we think about our space.
Got it. No, great. And so impact investment, so it's a real impact investment play here with Aqua, right?
Yes, we are not, I would say we're not an impact investment per se, but impact is very much what we do. And look, food and ag is, and maybe ag more specifically is one of the largest areas of untapped impact in the world. And so most of the things we do, almost everything we do, is related to impact, and that's something that the firm has kind of almost naturally evolved into from a variety of reasons. But as private equity investors, we don't have 10 or 15 years to figure out where an investment goes within a life cycle. It's usually a very shorter cycle for us to make an investment, improve the company, and exit it. And so from that perspective, we have a very low tolerance into missing anything within our investment. We cannot have any misses. And so impact is something that we take very seriously from the very early stage of sourcing. because impact is impacting the consumers of our company, whether these are B2B consumers or whether these are a B2C consumer, if you will. Impact is investing, is impacting the way we produce, the way our company is producing things, the way they go to market, the way they operate within a regulatory framework, even to the extent of how much interest a company would have as a target from a potential strategic buyers, from the fact that our typical strategic buyer of a company is usually a larger company, often listed, and they're going through rigorous impact restrictions of their own. And so we need to think what the impact environment is going to be. Think about it 5-7 years from now, when we're going to be exit the company, and how would our target company be perceived by our potential acquirers? If a company has certain commitments as it respects to emissions, would our portfolio company be helpful in getting into these mandates, or actually take the company a few years back, which is a tough place to be. And so we design almost everything we do around impact, again, from the diligence side, from the more advanced diligence side, and into the operational side. Impact is embedded in everything we do.
And sustainability as well, environmental sustainability benefits as well, right?
We would include that as we would use the code name of impact as part of that. There's obviously within an ESG perspective, there is obviously only one of the areas, but yes, environmental, sustainability, equality, all of these areas are issues that we as a fund are laser focused on.
Yeah. Okay. Got it. So tell me, as someone spent 13 odd years in banking, as it were, and now working for an impact private equity fund, how different is that? The environment, for instance, and having that mission behind you, as it were, what are the differences?
I mean, it's very natural for you as an investor, because as an advisor, you're kind of coming in and coming out of situations very quickly. You could be working with a company for a year, for about half a year, and helping them achieve a specific area. And so your ability to create an impact is limited, because at the end of the day, you're there to execute a mission. But as kind of my days throughout Credit Suisse have gave me a really kind of interesting vantage point into how strategic buyers are thinking about impact. As an example, we're selling an asset in a specific area. In my view, a great asset to sell, very, very nice gross margin, very nice cash flow profile. However, most of its portfolio was synthetic. And as it was, even though the fact that business fulfilled a very critical point in the functionality the products were providing, the strategic interest for that business was very low. And for me, it was an interesting way to witness where the industry is shifting. As an investor, as I've mentioned, you have the ability to make impact. You're investing money in companies. You're taking ownership or taking a significant minority position, and you have the ability to navigate them. Not just the ability, you have the necessity to navigate them into a space which would be, you'll impact how the business is going to shape and look like in 5 to 7 years. And so you have I would say you have an impact to force an impact strategy. And from that point of view, it's very different. And embeds a great deal of responsibility, I would say, too.
Yeah. Okay. No, great stuff. Where are we on the journey when you think about when you think about agriculture and you think about over the last 13 years, the major consolidation from 6 down to 4, you know, you can see all the innovation happening now with these early stage companies. Well, where are we on this agriculture kind of journey now, do you think? And what does the future look like for it?
I mean, look, I think we hear a lot about impact, innovation, whether this is areas such as nitrogen fixation, biologicals, new nutrition, water preservation, genetics. Having said that, the percentage of agriculture products, inputs that and food too, I think, that we would today define as impact is fairly low. This is a very high growing category, but today the majority of, if you think about crop protection, if you think about nutrition, and even if you think about the way our food is being produced, the majority of that is still remains synthetic. And so there is innovative ideas. We as a firm invest in many of them, but we must not forget the majority of the space that is still synthetic. And so one should think about, okay, the world is going to look different in 10 to 15 years, but there's also a transition economy. How do we make things less synthetic? How do we make things more natural, less harmful, more impactful? And that is also a critical piece that I find sometimes the industry is ignoring, and impact. The future technologies take a big deal of discussions, but there's not enough discussion on the how are we going to transition the rest of the economy today. So I think if you think about where industries are going to go, and I separate it from between food and ag. I think ag today is an input dominated industry. I think 10, 15 years from now it will continue to be that, but we'll see much more. We'll see budget, I think, shifting from inputs into services, whether this is at the farmer level, whether this is at the distribution level, and many of that will be on the account of using less inputs and service, I think, because at the end of the day, service is going to help the grower, help whoever is producing our inputs, make a better job with less. I think service is going to become more dominant. That could play into software, that could play into IoT, what we call digital ag today, that could play into many different things, that could play into genetics, synbio, etc. On the food side, I think and in a way on the care side too, because these two industries in many cases go together, I think we will see ingredients going from synthetic more into the natural, plant-based, bio-based. I think we will see food processing being less commoditized, more specialty, maybe smaller batches and more suitable. I think we will see more on the medicinal food side. What are we eating as a way of disease preventing, better way of living, etc. So I think we're going to see more trends of that. But watch the transition side, because I think some of these trends, I think some of the trends that will be impact are going to be around taking what is less impactful today and making it more impact, maybe less synthetic, etc. I think that is a space that is still yet to be explored in a very meaningful way. Yeah.
Okay. I mean, look, it's a lot of exciting times ahead. Tell me, what's your view on, we've had loads of technology, new kind of technology. Is your sense that there'll be a consolidation of some of this earlier stage technology, basically, and maybe a roll up of some of the earlier stage kind of companies?
I think it depends. It depends on the sector. It depends on the space, right? Some spaces require, for example, synthetic biology or genetics. There are some spaces that require a great amount of money and a great amount of time until they get to fruition. And so consolidation could be one area, but look, there's also a sense of winners and losers. Some technologies would absorb the meaningful amount of money, and will not necessarily get commercial. Maybe they're going to be the foundation of another technology that will be relevant. I think that look, the way I see things is that technologies that will be consolidated in an impactful way will have to get closer to commercialization rather than early stage. And so I do think that we'll see, if you think about the big four today and what they're going through, right? I mean, Bayer effectively consolidated with Monsanto, Dow, DuPont, BASF after the acquisition of the Bayer portfolio are still pretty much in a consolidation and kind of figuring out space. And I think the bigger companies would choose which technologies to be focused on and which technologies to acquire. And since they haven't been very active recently, I do think that we're going to see some of them start acquiring again. And I do think that we're going to see new entrants into that space as future potential leaders. Having said that, I do think there's going to be a shift towards technologies that are more commercial. And I always have an example. I remember having a discussion with a company I'm still very close to, where the CEO had growers using his technology and many growers using his technology. So, okay, I think we're ready to launch our beta version. And I told him, hey, your technology is already commercial. People read this, yeah, it's not quite there. I said, look, it's not necessarily about being with the best technology. Many technologies as of today are commercial, and offer already a much bigger advantage than what's exists in the market today. And I still see, CEOs and boards hesitant to test technologies in the market. But I think that the solutions that are going to take us and are going to impact us in 10 to 15 years, the technologies of theirs and the solutions of theirs, are already in the market. And in a way, I think when you put it at the field, or when you put it into food manufacturing, and you can create an impact, I think that is something that we see some companies a bit hesitant to do. Even though what they have today is perfectly sufficient of being a commercial technology. Does that make sense?
Yeah, absolutely. Tell me, what do you think? What do you find are the biggest challenges in deploying capital in this marketplace now?
Yeah, I mean, look, I think one thing I do have covering the sector for quite a while is perspective, and I think we've seen how the world looked like at 07 and 08, where commodity prices were high, then kind of went low again, and then went high again. And I think one thing you do need to think about food and ag, these are not fast-moving markets. These are slow-moving markets. They may go a bit faster, but I think adoption of technology takes time. And this is not healthcare in a way. That there's the scale, the penetration, the amount of money required is different. And so I think one is be very prudent around your assumptions, around growth assumptions, around margin assumption, but also be realistic, right? At the end of the day, it's one thing to convince a technology consumer in a different space, whether this is online ads or software, et cetera, to convert. It's more difficult to convince a grower to adapt new technology, new variety, new biological product, new agri-tech, because his livelihood is dependent on that. And so, we always humbled by the way growers and other kind of industry participants are are kind of are adapting new technologies. But then when they adapt the technology and when they're happy with it, how sticky that technology is with them. And so I think understanding these perspectives are important. And for us, I think this is one area where I think sector specialization, creates a huge advantage, because it's easy, I think, to fall in love with stories, and it's easy to think big. But on the other hand, this is a very practical area, and kind of seeing 7, 8, 10 biological companies before really helps you analyze the next one. Looking at 7, 8, 9 digital ag plays really help you get into a better, more realistic conclusion on your next investment in that space. And so I think perspective, as well as the ability to think globally, is extremely important.
Yeah. You know what, Eli, thank you for that. I was just thinking back as well to some of the strategies companies have at this stage as well. And what I've heard lots about over the last few years is asset-light businesses. Lots of CMO relationships. Essentially, it is, people avoiding steel in the ground and big capex, and is that the way forward still, or do you eventually have to bite the bullet and invest in your manufacturing?
I think asset light is kind of almost the name of the game in many areas of investment. I would say it depends. I don't think we necessarily have an issue with more asset intensive business, but to the extent they give us a structural advantage and in shying away from the commodity price and from commodity dynamics in general, and give us stability on the gross margin and the ability to supply. I mean, one thing that we learned from COVID is, owning production plan is extremely important, because you own another leg of the supply chain. And ag is about stability. You need to provide your product to your customers on time, at the time. If you're providing it a day late or 2 days later, that may be as not providing the products at all.
Yeah.
And so from that perspective, controlling your supply chain, controlling your plants helps you a lot. Now, I think we all like better ROIC. That could often come with asset-light approaches. But we cannot lose sight on what's important, which is providing our products on time and being able to control destiny and control margins too. So I would say it really depends. We as investors don't necessarily have anything against asset light, again, as long as it doesn't take us into a direct commodity exposure and lower ROIC.
Yeah. Okay, great stuff. And tell me, IPOs, is it the poison chalice? I mean, I've just read about stuff over the last year, the amount of companies that have IPO'd, it hasn't worked out. Is it a poison chalice, companies IPOing in this space?
Yeah, look, IPO, ag is no different than other spaces. IPO is a relevant toolkit at a lifetime of a company. I don't see IPO as a target, because, as an investor, whether you're a personal investor, whether you're a fund, IPO is another way for the company to raise funding. It doesn't mean exiting your investment under an IPO is a whole different story. Sometimes easier, sometimes more difficult, but IPO, in a way, I would compare it to a private capital raise. Now, I think the question, the traits of the IPO buyers, of basically investors looking at the IPO markets, are shifting. They started, and they keep shifting all the time. But what we've seen in the last wave are companies that are growing fast, with meaningful revenues growth being the flavor of the day. That is shifting now towards more cash generative, margin protection, etc. So I still think that company needs to reach some sort of a maturity before they go to an IPO, and that's not necessarily a maturity, a financial maturity. It's about management maturity, the ability to predict their business, how stable is your sales cycle, how stable are your customers, because it's not only to deliver, to deliver growth. As a general statement, you need to deliver quarter by quarter to keep your share price there. I do think that we have seen companies going too early when they don't have enough revenue, sometimes when they don't have revenues at all. And more importantly, or equally importantly, when they don't have the ability to control cash flow. Now, in a market that is pretty volatile, you really want to be your IPO to really kind of take you from negative cash flow at least into a positive cash flow, and your ability to sustain the business, because if your share price drop meaningfully, your ability to raise more money as a public company in a way diminishes. And so I think going early could be sometimes a dangerous game for companies. So I think what we'll see and where this market would evolve, I think it would. Look, the food and ag industries are one of the least represented industries in the public market. If you wanted to invest in, let's say, a mid-size ag input company in North America, these are rare assets to find. If you want to invest in a consolidation play that go for acquisitions in some areas of food, it's not an easy thing for you to do. And so I think we will still see more IPOs to come, because investors would require that there's enough investor demand, and this is one of the best fundamental sectors to invest out there. But I think we will see a gradual shift of companies going when they're more ready. They're not going to the IPO because it's an opportunistic way to raise money, but they're going to the IPO because they reach a maturity level where they're stable enough, they're predictable enough, and they're really ready to be public companies. And I think that's the way we shift. We mean slightly larger companies that already have positive cash flow and have a specific scale, and companies that can actually predict their future pretty surgically.
Yeah. Okay. Great stuff. Just to finish off with just a couple of quick fire questions, Eli. Tell me just some great advice you've received over your career that stands out.
Yeah. I mean, I think the ability to leverage yourself from a team perspective is probably one of the best advice I've received. You're always going to be able to achieve more, when you work as a team, and that's a culture that that we have at Aqua, and I have with the teams working with me. Whether you're an intern, an analyst, an associate, a VP, your view, your view about a specific business, about a specific investment equals mine. If you see an issue with an investment, if an intern of ours would see an issue with an investment, it's a good reason enough for us to have serious doubts and to have a debate and potentially kill an investment. We've done that. We've done that various times, and the reason is these are small teams. Everyone is kind of pulled into various directions. Each of the team member has a critical view, and so your ability to leverage yourself over a team is important. And hence, I think we all have limited time. Focus on the right situations. Focus on stuff that are long-term, value creative. That are within middle of the fairway for your organization, and execute them rather than have various things on the go. So have your team focus on executing the most important things for your organization. Whenever I focused on that, I managed, I was successful. Whenever I diverted from that, there was always a pain at the end of the stick.
Yeah. Oh, I love that. Thank you for that. And just tell me a leader, a particular leader that you've worked for or with that you've really been inspired by.
Look, I was blessed to work with many leaders in my careers whether this is my friends at Aqua, and whether these are the people I've worked throughout my career at Credit Suisse. I take advice from people who work with me, whether they're my superiors or people who are working for me. I would say there have been a few folks at Credit Suisse that I've worked throughout the years that impacted a lot my decisions and the way I see things. Obviously my partners at Aqua, who I'm very close to, and I'm getting a lot of advice from. I think as a way, at least for me, as a way of living, I like to take advice from people. So I don't make the same mistakes other people have made, but also so I leverage myself better.
Yeah. Okay. All right. Great stuff. And just final thing. What causes you stress? What's the most stressful thing about your job?
I wouldn't describe myself as a stressful person, whether this is growing up in Israel, going through the army cycle, et cetera, et cetera. I would say, sometimes when there's too many situations and too many things to do, it could get a bit uncomfortable. Not the stress level, but a lot of things, a lot of decisions to take could be uncomfortable. Usually, and different people deal with stress in different areas. Some people do meditation, some people do cooking. For me, the best therapy is kind of disconnect and do sports. I've been a windsurfer from a very young age, and later on became a snowboarder too. I'd love to do these activities. Obviously, living in New York City, these are not too handy. So I would go for a run or do I would do a cycle or something like that. That usually disconnect me and kind of charge me up again.
Yeah, great stuff. Great stuff. Well, look, Eli, it's been great conversation. Thanks a lot for your perspective and your time. Really enjoyed talking with you.
Thank you, Simon. Thank you very much.
Excellent.